Welcome to this explainer. We are skipping the pleasantries today and jumping straight into the mechanics of a truly phenomenal year for mid-cap industrial powerhouse. We're going to unpack Graham Corporation's fiscal year 2026 financial results, and honestly, it is a textbook case of a cause and effect growth engine in full swing. Let's dive right in and see exactly how their strategic investments are translating into massive scale.
$532.6 million. Let that number sink in for a second. That is Graham's record backlog at the end of fiscal 2026. For an industrial manufacturer of this size, having over $500 million in locked-in future revenue, that's an absolute game changer. It sets the baseline for everything we're going to talk about today.
And what's driving that backlog? A massive 1.5x book-to-bill ratio for the year. Put simply, for every single dollar of product Graham ships out the door, they're taking in $1.50 in new orders. They're literally pulling in demand vastly faster than they can currently clear it. So you have to ask, how did they get here?
That brings us to Section 1, the what and the catalyst. To understand that $500 million backlog, we first need to look at the specific high-demand industries fueling it.
Before we get too lost in the heavy financial metrics, let's ground this in physical reality. Graham Corporation is a global leader in designing and manufacturing highly engineered, mission-critical equipment. We're talking about complex fluid, power, heat transfer, vacuum, and advanced mixing technologies. You know, this isn't off-the-shelf hardware you can just order from a catalog. This is bespoke, highly technical engineering.
Manufacturing this kind of hardware requires incredible precision. We're talking about intricate machined components working right alongside advanced automated welding. And that creates a massive barrier to entry for competitors. Producing these parts requires immense engineering capability, incredibly specialized facilities, and exacting quality control. You just can't fake this kind of expertise.
Because of that precision, these bespoke components end up in some incredibly critical places: submarines, aircraft carriers, space launch vehicles. Right now, the defense and space sectors are the primary catalysts, acting as massive tailwinds for Graham. These are critical national security and advanced exploration markets, and the demand there is fundamentally accelerating.
So the crucial point is how all of this translates into revenue drivers. In fiscal 2026, Graham really capitalized on these massive tailwinds in space and defense. They did it through strong operational execution, expanding their capabilities and securing entirely new programs. And they achieved all this forward momentum even while their aftermarket segment dipped from previous record levels. Their operational strength was so robust that they just powered right through that dip.
Let's move to Section 2, Strategic Facility Expansions, the blueprint for capacity. Because let's be real, if you have $500 million in backlog, you absolutely need the physical footprint to actually build the stuff.
And Graham didn't just announce plans and sit on them, they aggressively rolled out physical expansions throughout the entire year. These are high return on invested capital projects, meaning for every dollar spent, they're targeting over a 20% return. In the first quarter, they wrapped up the Barber-Nichols Assembly and Test Facility. In the second, the massive Batavia Navy facility and a liquid nitrogen testing site. And by the fourth quarter, they were already commissioning a new cryogenic test facility down in Jupiter, Florida.
I really want to focus on the sheer scale of that new Navy facility in Batavia, New York. Completed in the second quarter, this expansion is explicitly dedicated to handling the surge and defense work. It represents a massive footprint increase dedicated entirely to clearing that backlog we discussed earlier.
And here's an incredibly telling detail about that Batavia expansion. It cost $17.6 million, right? But it was remarkably backed by a $13.5 million customer grant. Think about what that actually means for a second. Graham's defense customers are so eager for this manufacturing capacity, they literally provided the grant funding to help build the facility. I mean, that is the very definition of locked-in demand.
But capacity expansion isn't just about floor space. It's also about advanced testing. At the Barber-Nichols propellant test facility, expanding testing capabilities, like the liquid nitrogen testing that came online in Q2, allows Graham to validate their complex technologies in-house. That smooths out the production bottleneck and gets units delivered to the customer way faster.
All right, Section 3, the FY26 Financial Scorecard. Let's examine how these strategic investments actually translated into hard revenue and bottom-line profit.
The result is a fantastic story of reliable, compounding scale. In fiscal 2024, revenue was $185.5 million.
In 2025, it ticked up to $209.9 million. And here, in fiscal 2026, the engine reliably scaled up to a massive $245.3 million. That is incredibly consistent year-over-year top-line growth.
But breaking down that $245 million reveals some really interesting internal dynamics. Defense revenue shot up 20%, and space revenue climbed 14%. Those two segments were absolutely the heavy lifters for the year, completely overpowering the anticipated 24% drop in aftermarket sales. The core strategic markets delivered exactly as planned.
Moving down the income statement, we see how that revenue distilled into pure profit. For the full year, gross margin landed at 23.5%. Net income was a solid $12.5 million. And importantly, adjusted EBITDA reached $26 million. The company is proving it can profitably convert its massive top-line growth, which is exactly what you want to see. Now, you might be wondering about that 23.5% gross margin. It actually represents a slight decrease of 170 basis points, or 1.7%. But there's context here. This was primarily driven by a shift in product mix, specifically a higher volume of defense work and material receipts compared to their higher margin aftermarket business. It was also impacted by a $1 million tariff hit and the non-recurrence of a previous Blue Forge Alliance grant. So these are very specific, understood factors impacting the margin profile, not systemic issues.
Which brings us to Section 4, looking ahead and the backlog engine. Historical performance is great, but here is where we see the true power of Graham's demand engine moving into the future.
If you were wondering whether this demand is slowing down at all, the data provides a definitive no. Total orders surged from $268.4 million in fiscal 2025 to an explosive $359.4 million in fiscal 2026. The pace at which they are capturing new business isn't just steady, it's actively accelerating.
And when we break down that backlog, it shows exactly where Graham's future lies. A staggering 85% of their fourth quarter future work is locked securely into the defense sector. With energy and process at 8% and space at 7%, it is crystal clear that the U.S. defense industrial base is the bedrock of Graham's operational future.
Which leaves us with this final thought to take away. We've seen the unprecedented demand, those incredible customer-funded facility expansions, and the surging financial metrics. With a 1.5x book-to-bill ratio locking in future work, and those new defense capabilities just coming online right now, how high can Graham's cause and effect growth engine climb in fiscal 2027? It's a fascinating question, and one the data suggests will be very exciting to watch unfold. Thank you for joining me for this explainer.